All right, let's dive right into one of the biggest questions in tech and finance today. Are we actually living in a massive, totally unsustainable AI bubble? See, the idea here is that this isn't some fragile bubble just waiting to pop. Some analysts are arguing, but what we're seeing with the AI boom is something way more deliberate, like a massive engineered financial structure. A dam, really, built to hold and control a ton of financial pressure. I mean, with stock valuations going through the roof, you've got the IMF issuing warnings, and even the CEO of OpenAI has admitted we're probably in a bubble. So yeah, the debate is hotter than ever.
Okay, so first up, let's look at the case for a bubble. We're going to explore the argument that we are, in fact, inside a bubble, and we'll look at the cracks that are starting to show up in that big financial dam.
At the very heart of this whole bubble argument is a concept called circular financing. Basically, it's a system where money just moves in a closed loop. It makes it look like new value is being created, but in reality, the same cash is just being passed around and counted over and over and over again. And right now, it's happening on a scale we've never seen before. And this visualizes that loop perfectly. You can see how every single company involved gets to put growth on their balance sheet. But the critics are asking a pretty simple question. Is any new money or value actually entering the system, or is it just the same cash going round and round? And here's where it gets kind of crazy. According to an analysis from Sequoia Capital, the entire AI industry needs to grow its revenue 17 times over just to break even on the money that's already been spent on infrastructure. That's not to make a profit, that's just to justify the checks that have already been written. That is some serious pressure building up behind the dam. And look, this should matter to you because these few tech giants, the so-called Magnificent Seven, they now make up more than a third of the entire S&P 500. So what does that mean? It means the risk is incredibly concentrated. If you've got a 401k or any kind of index fund, you are way more exposed to this than you might realize. And it's not just talk. We're starting to see real cracks appear as the very people who built this whole thing, well, they're starting to hedge their bets. Nvidia CEO is backing away from a huge OpenAI deal. OpenAI is looking at other chip makers. And maybe the biggest red flag of all, key insiders are quietly selling off billions, that's billions with a B, of their own stock. You could say they're moving to higher ground. With all this evidence, it's really easy to see the parallels to the year 2000, right? You've got a revolutionary new technology, you have investors going crazy, and valuations are just skyrocketing. But is that really what's happening here? All right, but now we gotta flip the script. Let's look at the other side of the coin, because there are some really good reasons to believe that this time is different. And there are some pretty important distinctions to make. And this chart really spells it out. The biggest difference? Back in the dot-com era, a huge chunk of those tech companies weren't even profitable. Today, it's a completely different story. These AI giants are absolute cash-generating machines. They're making 3 times the cash flow compared to their valuations back in 2000. And those valuations, while they're high, they're still not at the insane peaks we saw back then. So what that means is, if one of these giants makes a bad AI bet, yeah, it's going to be a painful multi-billion-dollar write-off, for sure. But it's not necessarily going to trigger a whole market meltdown. Why? Because they're using their own cash, huge piles of it, to fund this whole thing themselves. And yeah, that circular financing thing we talked about, it's real, but it's only a small piece of the puzzle. Just look at Nvidia. In the last year, it generated a staggering $77 billion in operating cash. From their point of view, it just makes perfect sense to reinvest some of that money back into their own ecosystem, to basically create their own future customers. Okay, so where does that leave us? We've got 2 completely different stories that both seem to make sense. On one side, this fragile dam built on funny money. On the other, a solid foundation built on real profits and cash. So, what happens next? Well, the most likely path forward probably isn't a total collapse. It's more like a painful consolidation. Think about it. The internet didn't die with the dot-com crash, right? All the weak companies got wiped out, but a few huge players, the Amazons and Googles of the world, emerged even stronger. That's probably what we're looking at here. The technology itself is real. It's revolutionary, even if a lot of the companies trying to cash in on it aren't. And you have to remember this classic warning. Even if you're a genius and you correctly spot a bubble, timing when it's going to pop is basically impossible. Alan Greenspan first started warning about irrational exuberance all the way back in 1996, but the dot-com bubble kept inflating for another 3 years before it finally burst. So, at
the end of the day, here's the big takeaway. Both things can be true at the same time. The AI revolution is absolutely real, but the AI bubble is also very real. We're living through a genuine tech revolution that happens to be wrapped in a financial structure with some serious weak spots. And that leaves us with the critical question of what happens when those two realities finally collide.